You have been told that your 401k is a tax advantage, and it is right now. But here is the question nobody asked you, the one that keeps some people up at 2 in the morning. What tax bracket will you actually be in when you start pulling that money out? Because every dollar sitting in your 401k right now has a tax bill attached to it that you have not paid yet. And that bill is going to be calculated at tomorrow's tax rates, not today's. In the next 8 minutes, I'm going to show you the math that most financial advisors never put on a screen in front of you. Every 401k is built on one assumption that nobody stated out loud when you sign up. The assumption is this, that when you retire, you will be in a lower tax bracket than you are in right now. That is the entire argument for pre-tax saving. Defer the taxes now, pay them later at a lower rate. Come out ahead. It's a reasonable assumption for some people in some situation. But let me ask you something. If you are earning $150,000 to $250,000 right now, and you spend the next 20 or 30 years building a business, investing in real estate, or growing your career, do you actually believe that your income in retirement will be lower than it is today? And even if your earned income drops, your 401k forces you to take required minimum distributions starting at age 73. Whether you need the money or not, whether the market is up or down, whether tax rates are higher or not. The government decides when you withdraw, the government decides how much, and the government takes its cut at whatever tax rate they choose. In our last video, we show you that your money is locked inside walls. You cannot reach it without a penalty. That was the access problem. What I'm showing you right now is the tax problem. Let me show you what this actually means in numbers. This is a real scenario, not a worst case, a realistic case. A 37-year-old professional contributing $2,000 a month to the average 401k plan for 25 years. Projected balance at retirement, approximately $1.55 million. That number looks impressive until you remember what it actually is. It is not $1.55 million. It is $1.55 million minus whatever tax rate applies when you are forced to take it out. At current brackets, and brackets can only go in one direction, given the national debt, you could give back $272,000 to $363,000 of what took you 25 years to build. Now look at this comparison carefully. The 401k balance is larger. I'm not going to pretend otherwise, but look at what you actually get to spend. After the government takes its share, after required minimum distributions forces you to withdraw on their schedule instead of yours, after 25 years of market exposure with no guarantee that the balance survives intact. The spendable, accessible, tax-free cash value of a properly structured policy is competitive with a 401k that look much larger on paper. And that policy have no required minimum distributions, no market risk, no penalty for accessing it before 59 and a half, and no tax event when you use it. I'm Pedro Palicio. My wife Isis and I founded Universal Wealth Managers, LLC, in 2005. We were trained in the infinite banking concept by Nelson Nash himself, the man who created this strategy. Since 2008, designing these policies has been the only thing we do. We have done this for thousands of clients across all 50 states. Here is what that experience had taught us. The alternative we design for our clients addresses the tax problem at the structural level. A properly structured whole life insurance policy funded through the infinite banking concept grows your cash value on a tax-deferred basis. You can access it through policy loans, and policy loans are not taxable income. Not a deduction, not a shelter, not a loophole. A contractual right built into how the policy is designed. When you retire and need income, you can take withdrawals down to your cost basis. That means the total premium you have paid, completely tax-free. And then switch to policy loans, which are also not taxable income. No required minimum distributions, no forced withdrawals on government's schedule, no ordinary income tax on what you access. Your money, your timeline, your terms. Now, I know that some of you are thinking, Pedro, whole life insurance has high fees. The returns are lower. Dave Ramsey says, buy term and invest the difference. Here is what that argument ignored. Buy term and invest the difference assumes that the difference gets invested every month for 30 years into an account that grows tax-free, not tax-deferred. It does not. Your 401k is tax-deferred, and we just look at what that cost. Here is what I want you to do next. In the description below is a link to our free ebook, Policy Loans, the one financial move that lets your money work in two places at once. Download it. No cost, no strings. And if you are between 30 and 55, with a gross family income of $150,000 or more, and you want to see what a tax-free retirement would actually look like with your numbers, book a complimentary strategy call. Link is in the description. We answer every question within 24 hours. Our services cost you nothing. One more thing before you go. We just covered the tax problem inside your 401k, but there is a second problem. One that is just as dangerous, and almost nobody talks about it by name. It is called sequence of returns risk, and it has nothing to do with how much your 401k earns on average. It has everything to do with when the market drops and whether that happens the year before you retire or the year after. That is the topic of our next video. And for high earners in their 40s and 50s, it's the most important retirement risk you have probably never calculated.